So we're talking about the central banks and their structures with a focus on the Federal Reserve System in the US. I also wanted to talk about the main role and the job of a central bank that's pretty universal across countries. And um, so on Bank for International Settlements, they have a list of all the central banks around the world, and it's actually quite interesting that, the US Federal Reserve System is incredibly unique. In many of the countries, the central bank is a single entity with branches, if you will, but they work very similar to a commercial bank and their branch system. The Federal Reserve, on the other hand, are almost 12 independent, at least intended to be independent from the get-go, institutions that behave like a central bank or individual central banks for their region. So, I mean, these are individual central banks that I'm going through, and as you can see, every country has a central bank of the country, or Bank of Japan, Bank of Jamaica, Central Bank of Jordan, Central Bank of Turkey, and as such. Um, and when you look at the monetary policy and the central bank, the general idea is that the central bank has this ultimate role to regulate the banking system. But I think I want to emphasize that when we talk about the banking system, we usually do not um, emphasize or focus on investment banks or exim banks or banks that are not posing depositor risk. Um, so even though it's a monetary policy and it is a banking regulator, I think the focus usually, or the heavy focus, is usually on the commercial banking side. So the with respect to the monetary policy, we spend significant time talking about how um, the Federal Reserve, for instance, changed their monetary policy from the dovish policy to a hawkish policy, and what does that mean, and why did they do this, and how do they achieve this? And the idea is that the central bank is the ultimate last resort for lending, or lender of last resort. And the central bank or the Fed also has the ability to borrow and lend money to institutions, either directly or indirectly. Fed also has the ability to issue, um, bonds and buy back bonds and create liquidity or suck liquidity out of the system. And through these, what we refer to as open market operations, the Federal Reserve is able to maintain a monetary policy. So the when we refer, and this is by the way, what I have on the screen is by IMF, and these are examples of what has been going on internationally, since the Great Crisis of 2007, and so the two terminologies, the dovish and the hawkish monetary policies, perhaps the parentheses here simply means that when the central bank has a monetary system in which they provide significant liquidity at a very low cost, and they become the great funder of the financial system, commercial banks, and the entire economy. We refer to this usually as a dovish monetary system. The idea is to promote economic growth. It usually comes after a recession. It stimulates business spending, consumer spending, investment. The intention is that the money will become so cheap that the companies will be able to borrow more, invest more, create employment, and the individuals will be able to spend more, and therefore you have a running cycle. And this dovish attitude is, like I said, it usually is reserved for recessions. However, when the COVID happened, for instance, or in the 2007, when the markets were subjected to certain risks, that even before a recession, Federal Reserve, for instance, started their dovish monetary policy. And therefore, the central banks are not actually required to wait for an actual recession to act. And again, in other parentheses, that a lot of the times the central banks have to be as independent as one can be. So even though these are independent banks that have independent management, they may be selected or elected by the governments. They simply cannot be fired. In fact, I remember when President Trump wanted to fire Chairman Powell, he really couldn't. And even though the president appoints, and then the Congress approves the Fed chairman, he was not in a position to fire him. And this generally is universal. And obviously, in certain countries, political pressure is heavy, and therefore the presidents or the chairmen of central banks can be actually fired. But the more political influence in central bank, the less influential central bank is in monetary policy implementation. So the idea usually is that the central banks need to be as independent, and their target and focus have to be given, or their charge have to be given by the government to employ certain monetary policy, currency policy, and then how they do this, and what vehicles that they use have to be within their own prerogative. So one of the jobs of a central bank is also to regulate exchange rates, and we talked about this a little bit, and perhaps in international finance we kind of talked about this a little bit more. The Fed does not intervene to the currency markets, and US dollar is a floating currency, so we don't really see this in the Federal Reserve system. However, we need to also learn about the other central banks around the world, and central banks can become quite involved in foreign exchange markets, and they could literally buy and sell foreign currencies against their own local currency in the interbank market or even internationally. And this interventionist attitude of a central bank, or the activist central bank, is rare. However, it's actually not that rare. However, the central banks usually take pride in not being an interventionist. But we always discuss how the risk, the return, and international flow of funds determines the exchange rates. And one of the ways that central banks achieve this, obviously, the interventionist, the foreign currency buying and selling, and direct intervention. However, the second one is through, manipulating the monetary policy, or the amount of money in the economy. And through this, the central banks can inflict pain in the market, and therefore cause their own currency to decline or devalue. They could also create a promotion, perhaps a subsidy to their own currency, and therefore their currency could gain value and attract foreign investment. They can do this through bond programs. They can do this through changing interest rates. They can do this through creating or allowing banks to create more money, and changing the reserve requirements, and obviously to work with the commercial banks to become more active in business and economic activity, and therefore increase international investment. So the while the exchange rate may be an eventuality of their work, sometimes internationally, the central banks may be more active and they might actually have a target exchange rate. So some countries will have, declared targets for their exchange rates. And one of the charges for the central bank will be to meet those goals. But monetary policy and exchange rate is more of a bigger definition or a bigger charge for the central banks in that their job is to maintain the the orderly process, orderly conduct of business for commercial banks to protect depositors and to make sure that the deposit insurance first, um, fine. And then their economy, they're also charged to maintain a stable growth in economy to make sure that there are no unexpected volatilities, and whatever volatility there is, it is within control. Um, you know, they also are charged to make sure that the inflation is not out of control. A little bit of inflation, maybe 2 to 3%, is perhaps inevitable, but anything beyond that can expose the economy to a uncontrollable economic decline and perhaps to recession. And one of the charges for the central bank's monetary policy is to maintain a lower inflation through whatever means necessary within their um, open market operations. And obviously, the exchange rate operations is also one of the charges. And obviously, for other countries, the central banks can have other um, duties. Like, for instance, I remember when I was working in Turkey, that whenever we needed cash, actual banknotes, the central bank was the provider. And whenever we needed to transfer funds internationally, and if we cannot do it as an institution, the central bank was always able to provide it to us. Um, Whenever we needed to conduct large business, um, in excess of our ability, central banks was always, or the central bank was always the bank that would help us coordinate it with the other banks. So, central banks are obviously nonprofit, um, but they're independent institutions that provide not just regulation and supervision, but also, consulting help, um, and their supervision sometimes is through maybe like a example of a big brother helping the individual institutions within their domain. So when we talk about, and that's why I actually have the IMF website open right here. When we talk about the central banks, and then we talk about the IMF, International Monetary Fund. Is the IMF the central bank of the central banks? And in a way, it is. However, obviously, it's not um, mandated so. Meaning, as a commercial bank, individual banks are regulated by the central banks, and in fact, the license of a bank is usually maintained by the central bank, and therefore the compliance is unquestionable. Um, and it's usually not voluntary, it is mandatory, meaning a commercial bank cannot simply say, well, I don't like these rules, I'm not going to go for it. It's just, there's no such thing. You're regulated by it, and then that's by law. You can be more active within the central bank. You can actually have participation in the management of the central bank, especially more so in the US. However, as a commercial bank, you are regulated by the central bank. When it comes to IMF, however, even though individual countries are partners to IMF and they provide funding and expertise, it is up to the individual countries to ask for IMF help. And even though IMF provides supervisory um, role or supervisory services along with financial and economic services, the supervisory role is always available. However, the financial role, funding role, may come with strings attached with monetary advice that may be mandatory part of the funding, and individual countries may not go for it. So, from a country perspective, being regulated by, well, perhaps I shouldn't say the regulation, but being helped by IMF is by choice, and the countries simply may choose not to be involved with the IMF funding operations. Um, so from that perspective, the central bank is, um, has, or central banks do have perhaps extended roles in other countries. And even though they are very similar in their activity and in their roles within the economy, they might actually have roles that are unique to each country. And again, for instance, in Turkey, uh, the like for instance in the US, the ACH system is independent, and in Turkey we had a very similar EFT system, and that was actually run by the central bank. So in the US we have chips, and for the domestic fund transfers, and uh, we have exchange systems and clearance houses, and again, in Turkey, for instance, we had all of this through the central bank. Um, and in the US, we have an entire system of Federal Reserve banking system. But again, in my experience in Turkey, we actually had one central bank with branches in each city, and they worked as a bank for banks. And so it was a completely different system. So the charge of the central bank can be quite universal. The monetary um, policy and the foreign exchange policy, and the economic stability, economic growth, and all of that may be universal. However, the businesses that are conducted by the central bank, and how that supervision is carried on, and how that regulation is carried on, can be quite different. And again, for the US, we have a Federal Reserve system, but for most of the countries, overwhelmingly most of the countries, we have a single central bank with individual branches. Um, yeah. So let's take a look at how the Federal Reserve banking system is constructed. And so to begin with, there's a, oh, yeah, so I will actually provide a link for the Federal Reserve System that actually explains the Federal Reserve System. They actually have a book. And obviously, this is an exhaustive amount of data. Unless you are planning to work for Fed, I'm not sure if you need that much data, or you're going to be sitting down for a CFA. I'm not sure if you need that much data. However, each chapter comes with a very nice, concise, almost like an executive summary, and I find them very, very useful. And furthermore, Fed is a great place to work, I've heard. They have very nice employment opportunities that I think that all of us should consider as an opportunity. So let's take a look at, and this is Federal Reserve system explaining their own system. And just as we talked about, they say that their charges are conducting nation's monetary policy, stability of the financial system, safety and soundness of individual financial institutions, payment and settlement system safety and efficiency, and promoting consumer protection and community development. So, and notice nowhere here it actually says anything about investors. So, like we discussed last week, I think that the financial systems separate the the deposit holders and general population from investors, and I think that investors are considered to be, and this is the book. The investors are considered to be a little more knowledgeable. Whether they are or they are not, obviously, is a completely different discussion, right? So within the federal system, we actually have three key entities, which we're going to discuss separately. But we have the Federal Reserve Board of Governors, we have the Federal Reserve banks, and we have the Federal Open Market Committee, and then we have the five key functions. Nations, just right here, just as we talk, five functions, right? So monetary policy, stability of financial system, regulation of institutions, payment and settlement systems, and consumer and community protection. There are 12 Federal Reserve banks, and these are started, I think, in 1913 was so the 1933 and 1935 Federal Reserve Acts, but the original separation of the 12 districts, I think, has to do with the 1913. Well, anyways, so we have, we're in Louisiana, in New Orleans, so we are in within the domain of Atlanta. So if you're going to be applying for a job, for instance, Federal Reserve Bank of Atlanta, New Orleans branch will be your target. So again, even though these are individual areas, they are intended to be 12 almost independent central banks. And that makes the Federal Reserve System incredibly unique. These are not like, an individual country having one central bank with 12 branches. This is not it. This is pretty, vividly, almost 12 distinct banks with central bank obligations. There are a few that are quite unique. Like, for instance, from my perspective, for research, it's always St. Louis. They have financial and economic data. So I'm not sure why that specific one is for financial data, but it is. New York has a special role historically, simply because most of the financial institutions, large financial institutions, are in New York, and therefore the Federal Reserve Bank of New York has a special place within the Federal Reserve System. The 12th district actually is also responsible for Hawaii and Alaska, and like I said, they actually behave quite independently. So when we talk about the Federal Reserve System, right? So we said that the Federal Reserve System comes with three key entities. The first one is the Board of Governors, then the Reserve Bank, and then the Open Market Committee, which, on Wednesday and Friday, we'll talk a little bit more about how these banks are involved within the system, what the individual roles are, and what the FOMC, or the Federal Open Market Committee, does, and how the members are elected, and so on and so forth. But these are the individual areas that, this Federal Reserve banks, and the board, the actual board, is in Washington, D.C., and the board itself is not an actual Federal Reserve bank. It's the board. So yeah, let's look at the Board of Governors. So the Board of Governors for the Federal Reserve System is almost like a board of directors for the entire system. And if you compare that to say a corporate structure, I would say that Federal Reserve System looks more like a holding bank or a holding company that has 12 separate entities within its domain. Each one has its own management and executive system and director system. And then you have this one great board of directors for the entire holding system, right? So for the Federal Reserve Bank, or the Federal Reserve System, Board of Governors is like that. Individual areas that we saw here have individual banks. They have their own management, they have all their executives and directors and duties and specific charges. And then the board is on top of all that and manages the entire system. So there are seven members or governors within the board of governors. Each one is selected for selected for 14-year term. Usually, the nomination is done by the President of the United States, and they need to be confirmed by the U.S. Senate. They cannot be fired, and if they actually leave the bank before that 14-year term, somebody can actually be elected to or nominated and confirmed to fill out the remainder of that 14 years. And once you finish out 14 years, you cannot be elected again, or you cannot be appointed again. So the chair of the Board of Governors is also selected by the US president and confirmed by the Senate. And they serve as a chair 4-year terms. They may be reappointed as chairs and vice chairs for additional 4 years, but the chairs and the vice chairs has to come from the board. So you cannot appoint somebody from outside to be the chair of the board. So the board responsibility is very similar to a board of directors. They regulate individual 12 banks. So they regulate all of these individual Federal Reserve banks. And they are the great overseers and supervisors and auditors, if you will, of the 12 bank reserve system. And they have an oversight responsibility of all of the individual banks. They also maintain the relationship between the, or regulate the relationship between the Federal Reserve 12 banks and their extent of operations with individual financial institutions within their domain. And and they also approve or review the budgets for individual reserve banks. And here's a chart for the Board of Governors of the Federal Reserve System. So you actually have the Board of Governors, and then Office of Inspector General, and then you actually have Advisory Council. So within that, you also have Office of the Chief Operating Officer, Division of IT, Information Technology, Division of Management, Division of Financial Management. And again, notice these are not banking related positions. These are more regulation related positions, meaning the Board of Governors regulate the 12 central banks. And I think that's what makes the Federal Reserve System incredibly unique. In countries where you have a single central bank, there will be one central bank and individual branches, and the branches act as an extension of the central bank, so agents of the central bank. So there will be branch managers, branch operations, but each branch would be very identical to each other, with very similar duties and very similar operations, and they will be just branches. In the case of the Federal Reserve System, these are independent banks, independent central banks. Each and every one of them has a unique, very common duties, but also they also have something very unique to each and every one. So the Federal Reserve Board is the regulator of the 12 central banks. So now you have a chief operating officer for the board, Division of Information Technology for the board. And then you have all of these, sub boards or subdivisions, if you will, and division of board members, Office of the Secretary, Division of Research and Statistics, Division of International Finance, monetary affairs, financial stability, supervision and regulation, consumer and community affairs, legal division, and then division of Reserve Bank operations and payment system. And then you actually have the currency division. You have board committees, right? So, but before that, each and every one of these divisions are above the 12 banks, and their job is to provide um, assistance and supervise their member banks or the 12 uh, Federal Reserve System banks, and to create a unified operational bank, operational foundation. So in and of itself, the the board system for the central bank, right here, the board of governance, is a quite unique structure, and in and of itself is a central bank for the individuals and for the supervisor, the director for the central banks of the United States. So there are several committees within the Board of Governance. Um, so Board Affairs, Consumer and Community Affairs, Economic and Monetary Affairs, Federal Reserve Bank Affairs, Financial Stability, Payments Clearing and Settlement, Supervision Regulation, and then the Subcommittee on Smaller Regional Community Banking. And obviously you have Advisory Council, and then I'm not sure what FFIEC stands for, but oh yeah, right. So Federal Financial Institution Examination Council, Controller of the Currency, Consumer Financial Protection Bureau, Federal Deposit Insurance Corporation, National Credit Union Administration, and the Federal Reserve Board. So as you can see, by being a member of the Federal Financial Institution Examination Council, Federal Reserve Board itself is keeping itself within the same level as a deposit insurance or National Credit Union Administration or controller of the currency as such. So the idea is not to create a one ultimate regulator, but this is still a central bank. So the structure again may seem as if it is more of a the regulator of all. However, it is actually just a central bank, and it is a complex system. So it's really not as simple as a single central bank countries. However, it is a system that seems to work quite well. So this chart also shows that the Congress is the ultimate overseer of the Federal Reserve System, and that's why, like for the past year or so, when the Fed started to change monetary policy, we see the Fed chairman, the chairman of the Board of Governors, as we refer to as the Fed chairman, explaining what they have done to a congressional committee. And the Congress, members of the Congress get to ask questions, and sometimes they can be quite tough. And so ultimately, it is, the central bank or the Federal Reserve answers to the Congress, to the people, and the Congress is the overseer of the entire system. Board of Governors is in the center of the entire Federal Reserve System. Within that, they actually have the 12 banks that make up the Federal Reserve System. There's a special committee called the Federal Open Market Committee, which consists of the members of the board, and then we actually have quite a few special members in that. So I'll talk about that on Wednesday. So I want to talk about this individual book. This is a substantial resource provided by the Federal Reserve, and it basically explains exactly what we're talking about and in great detail. And these are some of the jobs that they actually do and their structure. and how they actually perform their monetary policy. So I will provide some of these videos as part of a supplemental discussion material for our lectures. And I would appreciate if you go through them. They're very, very short, 4 or 5 minutes, and but they're very helpful and functional. So the concise but quite to the point. And so please let me know if there's anything I can do for you, if you have any questions. And I really do appreciate you guys working with me, and hope to see you guys soon. And thank you. So have a great day.